day or every week money comes in, whatever. There's money is made. Even if it goes out the window as fast as it comes in, it's still being made, and obviously it goes to different places. If you're in the higher levels above the paycheck crowd, then you've got your investments are paying off. You're getting interest in the bank. You're getting dividends from your stocks. You're getting other incomes coming in. You might have business income and things like that. So, and of course, if you're a business, because don't forget Warren Buffett's a business, right? He's got a company called Berkshire Hathaway. Berkshire Hathaway generates incredible amounts of money and puts some of that money back into the stock market. They buy more companies. In fact, he's just buying more Occidental Petroleum today, which isn't really worth discussing. He's been accumulating the company. Well, it's interesting. Actually, let's look at that. So here's Warren Buffett, and he's buying Occidental Petroleum, and he owns maybe 20-30% of it now, maybe 40%. I don't even know. It's a lot. He keeps acquiring it. So let's go weeks, months. Okay. So for at least 5 years, he's been accumulating Occidental Petroleum. And in fact, you can see these giant spikes are probably where he's been buying. See these things, the huge spike ups is where he's been stepping in and buying Oxy. So figure he's buying in at below 40, probably averaging in about 25, 35. Well, it's a big spread. Let's say he's coming in at 30, okay? And he owns 20% of the company. In fact, let's not speculate. Bodie. Let's ask our buddy Bodie. And CPI, PPI, okay. I'm trying to tell the story of Buffett buying Oxy and how his new offer for their whatever division is actually going to make him more money than he's spending by lifting the value of his existing shares. Can you please timeline all that with proper facts and figures? And of course he can, so I'm not worried about it. Oh, look at that. So Bodie says, here's the timeline for Oxy Chemical, right? Division. And you know how I like chemical companies, right? Because they're nice, boring companies that make money in all sorts of markets. And that's what and Buffett's liking that too. So here's what happened. So in 2019, Buffett starts investing in Oxy. And hang on a second. Sorry. So they're working on the roof, unfortunately, which is right where I am. So I don't know if you guys can hear it, but it's annoying the crap out of me. Anyway, so in 2019, he helped Oxy buy Anadarko. Then he starts accumulating stock in Oxy. He continues accumulating stock in Oxy. Buffett moves by Oxy. Wait. So he buys more stock, biggest shareholder by much. He owns 265 million shares. Oh wow, yeah. So he already owned 26%, 28% here, and he continued buying Oxy. Holds 8% plus warrants. I guess he bought another 8%. So he owns about a third of the company. All right. So he owns 27 plus 5 is like 35% of the company he owns. So now, and he meaning Berkshire, not Buffett personally. So now he turns around and says, you know what? I'm going to buy for Berkshire, even though he owns 35% of it already. He says, I'm going to buy for Berkshire the chemical division of Oxy Chemical for $10 billion. By doing that, he's infusing Oxy with $10 billion worth of cash. He's gaining the chemical division for Oxy, and watch what happens. Well, let's see what Bodhi says about it. So Oxy is at $5 billion in sales with okay, so he's got $5 billion a year in sales. They sell the chemical division to slash their debt. They hit their debt reduction targets, which and of course they've been talking to Buffett about this whole time. It's not like some sudden thing. They all go, I got a good idea. You know, this has been going on since he probably started. He's been planning this. So the deal impact, selling Oxy for $10 billion is seen as a good outcome for Oxy because it removes debt overhang. It lets Oxy return cash to the shareholders, which includes Berkshire Hathaway. Oxy's value is unlocked with the balance sheet. Buffett's profit loop, Berkshire wins twice, owning the cash-gushing industrial business outright while seeing its 28% stake in the Oxy jump in value. He's saying 28, so I'll take his word for it. And continued exposure to the entire oil and gas business. So facts and figures. In 2019, 2020, 25, post-sale, Oxy's got better debt. Takeaway, this isn't just an asset sale at a fair price. Buffett is capitalizing on both ends. Berkshire requires a double. Plus, don't forget, there's no competitive bidding here. He's just taking it. He's just going, here's $10 billion, you give me this, and they've already worked it all out. And of course, if there's a brouhaha about it, and that's why you wait until this point, right? Because if there's a big to-do where they say, that's not fair, you're giving away your chemical division for too little, who's the one who would make that complaint? The shareholders. Who are the shareholders? Berkshire Hathaway. They're 1/3 of the voting block at a shareholder meeting. So, and obviously the Oxy board is approving it, so they've got a big voting block, and boom, there you go. And you can't challenge this acquisition. So, Oxy slim down payment, parent can pay down debt, buybacks, dividends, blah, 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 blah. So Buffett's tactical genius here is turning capital-intensive debt heavy situation into a double payday. So what has he done? I mean, this is just phenomenal. You got to admire this guy. So he does it. He takes his investments. He's bought at a reasonable price. This is higher than what he's bought it for. And what he's done is when he just announced, well, let's do daily. This is week, monthly here. All right. So what has he done this year? He's accumulated more Oxy when it came down. He bought more, which is what he always does anyway. And now the price is going up. And now he's saying, okay, I'm going to take your chemical division off your hands, which is going to make me, you know, it's going to make Berkshire money. He wouldn't be doing it if it wasn't somewhere in line with Berkshire's normal profits. But he's giving Oxy $10 billion extra in cash, reducing their debt load. So Oxy is going to go higher because they're going to now announce the next earnings, which is not for a while, September, October, so November in a month. They're going to announce at the next earnings that they're in better cash position and they've got expansion plans and blah, blah, blah. They were already trading at 16 times forward earnings, so they're going to be in good shape. Not only that, though, but $10 billion cash right now, when other oil companies are selling off, means Occidental is in position to take that $10 billion and buy somebody else who's distressed. And what happens to Buffett, though? So you know, let's say he's in at 40. It doesn't matter what he's in at, but they're at 47 now. So he's at 40, they're at 47. They go to 54, and he's up 30%. And 30% of 1/3 of Oxy, which is $46 billion, Look at that enterprise value, 77. You rarely see that. You rarely see an enterprise value crushing a market cap like that. So Oxy is very undervalued. And so they could easily go to 54. Like I said, that's going to be a 30% profit for Buffett on 30% of Oxy, which is let's say $20 billion or $15 billion, $16 billion. So he's going to make $5 billion in profit on his stock at least, and I'm being real conservative with the numbers here. So he's going to make $5 billion in profit on his holdings that are already up from his years of accumulation, and Berkshire makes that money. Berkshire has already, so all Berkshire's doing is fronting the $10 billion. They get $5 billion back right away. They get a much bigger balance sheet with Oxy going up in value on the remaining shares that they have, and they end up owning the refining thing for nickels. You know, for it's, you know, the circular logic of it means they pick up that refinery not even half the price. So great deal all around. So Oxy's got a forward PE of 1670. It's probably going to go down. It will go down because that's 1670 before they get 10 billion bucks. So unless that chemical division, well, let's ask Bodie. What's the revenue and net profit of that chemical division? I mean, it's got to be 600 million plus, because otherwise Buffett wouldn't buy it. He wouldn't buy it if it wasn't returning 15x. Get out of here. $1 to $2 billion, $1 billion. What are you kidding? He's buying it for 10 billion. You see how ridiculous that is? Because the shareholders of Oxy should be outraged. 1.1 to 1.2 billion dollars. Their pre-tax net profit of 800 million, reflecting softer margins. Wait a minute. Oh, I'm sorry, that's revenue. No wonder it was weird. Well, okay, so 1 billion revenue, 800 to 900, and there you take 30% off, and it's my 600. There you go. Ooh, Q2 pre-tax profit 213 million. Yeah, okay, so 600 million. That is the right number then. Okay, I was going to say that's outrageous otherwise. So 600 million makes sense because 15 times 600 is $10 billion, and that's what Berkshire's paying for it, because those are the rules of finance. That's why. And so it's right about the number where the shareholders can't really complain. They couldn't do that much better in the open market. And this is an easy sale to a sure cash customer, blah, blah, blah. So anyway, so it's great for Berkshire because Berkshire trades about the same. That's the important part. It doesn't hurt Berkshire. Well, let's look over here. BRK. It's Berkshire Hathaway. What is this? BRK dash B. Wait a minute. Why is this thing being weird? Berkshire, there you go. So Berkshire Hathaway is valued at $1 trillion, and that's not what's important. What's important is they are running at, that's low. No, it's not. They're running at 23x. All right, so they're running 23 times forward earnings. That's the 1 trillion over 45. And that means that obviously, if they're buying the chemical division of Oxy, which is nice and boring and not likely to change very much, that they're going to add earnings at a lower PE ratio than the earnings they already have. So of course, that's a no-brainer. Any company, that's a no-brainer. If you can improve your PE by adding a business, and the business makes some kind of strategic sense for what you're doing, then you don't even have to make improvements. If you just run it the way it's running, it'll be fine. And Buffett will always tell you, you never buy a business where you can't, just leave it alone and walk away, and they know how to, and the people there know how to run it, because that's the only way he ever buys a business. So although they're bringing him under Berkshire's wing, there's no necessity for Berkshire's management to take it over or do anything other than pat these guys on the back once in a while when they come over with a bag of money. So that's Berkshire. So that's question number one. It certainly helps Berkshire, so there's no damage in this trade. Now, if you look at Oxy, it's the opposite. Now you have to say, what happens if I take away 600 million from Oxy? Well, Oxy makes 2.5 billion. So you're taking away 1/4 of their profits, right? The revenue doesn't matter. So you're taking away 1/4 of their profits. So now they're going to be they're still at the moment a $46 billion company. Calculator. All right, so they're still a $46 billion company, and now you have to divide. Let's say it's 25 minus 6 is 19. So now it's going to be divided by 19. That's 24 times earnings. It's quite a bit worse than they were, but now they have $10 billion worth of cash, and $10 billion of cash is 4 years worth of earnings. It's actually 5 years worth of the earnings once you take out the refinery, and their debt is 23 billion, 24 billion. So you're cutting their debt in half, but their goal isn't to be debt reduction. Most likely their goal is going to be they're probably going to acquire somebody. So let's say they find somebody to acquire. And this is how Bodie and I have our conversations. So, he does a little work and I do a little work, and in between us, we figure things out. So it looks like, and the nice thing is, he understands me at this point, so I don't have to waste a lot of time with explaining things. So it looks like Oxy will drop to net 1 point. What do we say? It's 25 minus. Oh no, it's 2.5 billion, so it's gonna be 1.9. Not terrible. I have the number wrong. It's gonna be better than we thought. So, Oxy will drop to 1.9 billion without the chemical, but with 10 billion cash. So, what are their 3 most likely acquisitions and why? Clearly, it has to be someone trading at about 15x or lower, so they can offer a 30% premium without hurting their own PE. So I'm talking to Bodie the same way I talk to you guys. I'm just saying, hey, let's think about what that would take. So annually, excluding chemical, with a significantly stronger balance sheet, Oxy's position to issue strategic acquisition. Here are the most likely candidates. So who do we look at? Permian. PE ratio 9 to 10. Why Permian? E&P geographic overlap with Oxy, offering synergistic scale, blah, 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 blah. Net income $750 million. Current market cap is only $10 billion. So they could buy them straight up for cash. Obviously, they'd have to pay $13 billion. You're not going to get it for 10. And they would add $750 million in earnings back. So it's more focused on what they're already doing, but it's going to bring in more money than the chemical division, $750 to $600 million that they're giving up. Murphy Oil is another good one. Why Murphy? Murphy makes $850 million, and you can buy them for $9 billion. That's pretty silly. Northern Oil and Gas, Well, let's see what he says. Murphy offers offshore U.S. Gulf assets and international exposure at a fair value price. Oxy diversifies its portfolio and leverages Murphy's mature production base. So for Permian, they have a geographic overlap with Oxy, so it's an economy of scale in the Permian Basin, and that they could probably drop that, bring that up to like over $1 billion. Murphy would just be an expansion of what Oxy does, so they're adding more things. And Northern Oil and Gas, 600 million, very cheap 600 million. Yeah, buyout is accretive at today. That's not my choice. I would go with Murphy or Permian. I think on the whole, I would take Permian. Let's see what Bodie says. Permian strengthens their leadership, improving economies of scale. Murphy gives Oxy blah blah. Northern Oil with 10 billion in cash, target 10 to 13 earnings, 20%. Oxy can make an immediately accretive acquisition. The market expects Oxy to act opportunistically. Oxy will drop to a net profit of approximately 9 billion annually. What? After selling OxyChem, 1.9 billion. Oxy is most likely acquisition. Oh, now he's bringing it out. Rationale. 30% premium to about 10.7. PR sub 10x makes the offer accretive. Murphy diversifies. It's a non-operator. All these targets meet the premium likely boost. I'd go with PR. Can you tell me why? See, and this is just, this is what I do with him. I teach him. I'm teaching him like the logic and what I think. Permian is a clear strategic choice. PR's core assets directly adjacent to Oxy's holding. Permian, especially, meaning Oxy gains contiguous scalable acreage for minimum thing. PR and Oxy have already transacted on significant acreage. Combining operations enables longer reach material, lateral wells, improved reserves, blah, blah, blah. So I'm sure that Oxy has been talking to Permian and saying, gosh, I wish we had money to buy these guys. They're so cheap. PR trades at 9 to 10, even with a 30% premium. That's going to be cheaper than Oxy trades. They generate substantial free cash flow. They check all the boxes. They have strategic focus, accounting for 55% of its total production, offering decades of high inventory for future drilling. They strengthen their leadership. Oxy's post-OxyChem, blah, blah, blah. According to acquiring Permian gives Oxy the greatest synergistic and strategic benefits, operational scale, and Permian strong cash flow and a creative deal structure. This deal is easy to execute, immediately additive to earnings and positions Oxy as even greater growth of the oil play. Okay. Great job. We used to charge people $100,000 to consult. Yeah, back in the day, we would have had a whole team studying the situation for like a couple of months to come up with the same answer. All right, great. So now we know, and we can make a trade out of that because we look at PR. So we want to invest in the energy space, but we want to find a bargain. So nobody, don't forget, I just made it really clear why Oxy would want to buy PR. Nobody else knows this. We're like 5 miles ahead of everybody else on this. And they might not buy Permian, but even if they don't buy Permian, it's a great company. It's got 8 times 4 PE, 10 times, but their PE went down. So I guess it's probably because the oil prices went down, but let's just double check that. Oops. So if we look on the futures and we look at oil, energy. Oh, wow, it's ugly. All right, so what's been happening this year? Yeah, look, it's been steadily. So from last year, because there's a dip from last October. So from last year in October, oil was 77 bucks, and that was actually low. All of last year was pretty good. Nobody knew in October of last year that oil would go from 75 to 60. That's 20% down. All right, so now you look at, you've always got to put context on what you're looking at, okay? So now we look at PR. Whoops. So now we look at PR. And now we say, okay, because the forward PE is 10, the backward PE was 8 or whatever. So what happened? Why are things getting worse? They're not getting worse numbers wise. Did they increase their share count? Did they sell something to get capital? That's the kind of stuff we'd want to look into a little bit more before committing to this trade. Their debt is really not bad. I don't think that's a big problem. I mean, I don't like 4 years worth of earnings as your debt, right? Because they make $1 billion and they're 3.7 billion in debt. I don't love 4 years worth of earnings, but it ain't 10 years worth of earnings, which is what a lot of people are in. We just looked at Oxy. They've got $35 billion in debt, or 24, sorry, they have $24 billion in debt, and they only make a couple of million a year. So a couple of billion a year, therefore 10 years for them to pay off their debt. So PR is in way better shape than Oxy is. And again, it improves their overall books. You're making more money for less debt, so on and so forth. And let's see, they're working their debt down a tiny bit, but nothing exciting. Profits are stable-ish. But anyway, so there's a synergy thing here, though, for Oxy, and that's why it's worthwhile. You can actually improve the operations, save a little bit of money, share equipment, share workers, so on and so forth. This makes sense. All right, so I am pretty comfortable with it, unless I find something weird when we dig into it further. I would definitely go with this one. And then the question is, now you say, well, is that a good trade then? Do we have a way to make a good trade out of it? So you look at trades, and we go over here, and we go PR. Hopefully they have long options. They don't really. They only go up. Oh no, they have 28s. Yay. Okay, fantastic. That's a selling point. They have last net. That's not so bad. Okay. I always looked at what the spread is. The spread is really wide. That's a red flag that they're going to be hard to accumulate. So the stock's at 12. We don't want to pay a big premium, so we look for something reasonable. Ooh, but this isn't bad. Look at that. So apparently we can buy the $10 calls for let's say 410 or something like that. The last sold for 403. So let's say we can buy these for 410, and we can sell the 15s for 210. And where do we think they're going to get bought? We think they're going to get bought for a 30% premium. That's going to be 350 higher. So let's say 16 bucks. So we think they're going to get sold for 16. I don't know if it's worth buying. I don't think it's worth it. So we'll sell these guys for $2, right? So we got the 10-15 spread for it's 410, let's say, and $2. So let's say 190. So it's going to be like 220 on the $5 spread. But we're going to sell some $15 puts because we think it's going to get bought away for more than 15. So let's say 340, 440, split the difference and say 390. So for 390 here, so we're going to do something where we sell the puts for 390. Like let's say we're going to do more than this, but let's say we sell 10 of them, right? For 390, that's $3,900. Then we buy these spreads, the 10-15 spreads. We said 220, right? So I know I'm getting 39 back. So if we do 30 of these spreads times 220, that's $6,600, right? Minus what I say, $3,900 for selling the short calls. So we're spending $2,700 on $15,000 worth of spreads. And in this situation, I do not want to sell very many short calls because the whole premise of our trade is that Oxy is going to buy them for 16 bucks. So I don't want to sell none, but so we have $2,700 to work with that we spent on the $15,000 spread. We're going to make 12,000 bucks if all goes well. So we don't want to not sell short calls, but we also don't want to oversell. So if we can sell like 5, we're not going to get burned too badly. And look at this price too. We can sell 5 of the, and we think we're going to get called away at 16. So we sell 5 or 7 of the $15 puts here because we have 30 long. So I'm not too worried, and especially at 15, I'm not willing to sell. In fact, we're not the only ones. That price is a lot. That's a big price to pay for calls that are $250 out of the money. These calls are 20% out of the money, and they're trading for that price. They're trading for 10% of the stock's price. So there's a lot of people betting on a 30% pop here today. So I'm not the first one to figure this out. This is the same. This is the price of the strike you'd expect to see if you expected a big 20% pop in this stock. So that's already kind of baked into the price. I agree with this. These are the ones we want to sell. So we'd sell 5 or 7 of those, and look at that. Look at that crazy price on the short puts, and we definitely sell 5 more of those. All right, so let's say we sell 5 of these is going to be $1,600 bucks, $1,600 at least on 5 of those. Plus we sell 7 of these for 130. So 7 times 130 is 910. So we're going to make more on the puts. So it's 910 plus 1,600. So we're going to sell 2510. That is the entire cost of our spread. So now we have a $15,000 spread for net zero. If we get called away, we're only going to get burned for the amount that they get sold for over 15. But anything less than 15, or if we don't get called away, all we do is roll them. Oh, I'm wrong. That's not this January. That was a big mistake. Okay. So in a year, people think they're going to make that much money, not in 3 months. So they're going to say, because 3 months is like crazy. All right. So do I want to sell these? I would sell 5 of these instead. I apologize. All those numbers were wrong. So we would sell 5 of these because I know I can roll them at least. So 5 of those for 500 bucks, the 13s, which are just out of the money. And we could also sell 5 of the 13 puts, and those are going to be $1.15. So that's going to be $750. So $750 plus 500, I think we said, is $12.50. So it'll take us 2 cycles to make our $2,500 back that we laid out on the spread. But it's the same principle, right? We can't get burned on both sides. We're just going to roll the losing side. And when we get hit, if they get bought out and the stock climbs up, we have 5 oversold short calls, and we'll easily be able to deal with that. And how much are we going to make? We're going to make something close to $30,000 on that spread. And frankly, for the LTP, because I can't do this spread in the income portfolio because, oh, you know what? I'd love to do this in the Money Talk portfolio. Oh, I'm going to be on Money Talk. No, it's not for a month though. Shit. If it's still open in a month, somebody please remind me, because I'm going to be on Money Talk right before Halloween. This would be a really cool trade. If we call this right, if I lay this trade out and it does what it's supposed to do, and we call, you know, I mean, it's like making a bank shot in a pool game, right? Because I'm calling Oxy to buy Permian, at $16. That would be a very nice trick shot. And I could get on TV and explain it all, and then I'll be like on TV with a television record of me telling people exactly what's going to happen. Of course, I'm wrong, but I think the logic is really, really sound. I don't know if they're going to wait a month until they announce something, though. That's the thing. Depends how long oil prices stay down. But in any case, again, for the long-term portfolio, we're going to jump right on this and probably double that size. The downside isn't that much. I think we sold 10 long-term puts. We sold 5 short-term puts. That's 15 puts. And the stock is only $12. So that's nothing. So we could sell 30 of those puts and double up everything. And then it would be 30 times 12 is, I don't know, it's not even money. I mean, 30 times 12 is not money. It's, what am I calculating? Fell down. So 3,000 shares times 12, 7, 6, that's $40,000. Okay, it's fine. $40,000 for the LTP is not a big deal. It's only 20,000 in total margin at max. And again, we're talking about a trade. That's our worst case obligation on a trade that will easily, if we double it, of course, the trade would make us $60,000 in profit, plus an income. If the longer we wait, the more money we make selling short puts and calls. Freaking love it. Love it. All right, any questions? No, because I'm so good. Oh, wait, sorry, Bernie. What do you think of Nike earnings? We talked about this yesterday. In fact, we had this exact issue yesterday because Bodie was foolish enough to make a prediction. And I told him, we've had that conversation too, because it was some member's fault. Let's find out who it was. Let's see how this conversation started. What? That's a weird combination, right? Okay, so all right. So he said to Bodie, or he didn't say to Bodie, he said to me, but I'm not stupid enough to guess on stocks. How will the stock respond tomorrow? So Bodie said, because Bodie always asks me. I don't print that, but he always asks me. He's always saying, "Oh, can I make a trade on it? Can I tell people how to play it?" And I'm like, dude, you can't do that. You can't just constantly it might be fun for you, I said, but realistically, you can't go constantly predicting things because you never know what a quarter is going to be. What you want to do, it's that's why I don't do day trades really, and I don't do swing trades because you can't be sure. And look, if I was an ordinary analyst like Kramer or whoever, and or any freaking person out there, if you look at I don't even remember what it's called anymore. Anyway, there's a tip ranks. That's what it is, tip ranks. You look at tip ranks, and it's funny, they won't track me. This has gone on for years. They won't track me because other traders have said it's unfair. I've had people complain because at one time they were going to start tracking me, and then people said it's not fair because most of my trades are private and blah 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 and whatever bullshit. But a lot of their people complain because, well, why do they complain? Because the average analyst doesn't do anywhere near what we do. Here, top analysts. Let's take a look. Look at this, 77. These are the best, and that's in a full-out bull market. I mean, we pick. We're in the 70s all the time, and we've got hundreds of picks, not a few picks, and so. These are their top people, whoever the hell they are, and and their recommendations are vague. I'm making specific recommendations with the trade idea and everything. These are people who just vaguely say, we call it a buy at this price, we call it a sell, blah, blah, blah. If I did that, I'd be at 99%. I mean, this is just insane. But we set up the entire spread and play it over time, and we do the adjustments and everything else. But these are the best people in the market, supposedly, but they're not, because I'm sure there are other people who they don't bother tracking. At one point, it was really pissing me off, and now I'm like, fuck all these people, assholes. Literally, not one of these, of course, because otherwise it wouldn't be ranked, right? None of these people, except for this guy, have any bearish trades. These are all bulls. And so, of course, if you're 100% bullish in a bull market, you're going to make money. And of course, the other thing about us is, by nature, we have options and we hedge. So we're purposely going to be losing a certain percentage. It's hard for us to get over 80 because we've always got 20% hedges. So by design, if we're making 90% correct predictions, it means that we're not doing our hedges correctly. So it's a whole different ball game the way we play. But these aren't, and that's the other thing. Oh, I don't have a firm. I forgot about that. These guys, most of these guys have firms. Truist, BMO, blah, 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 blah. So it's all in-house people. Oh, what's this? Individual investors. Oh, here he goes. Here's some individual investors. How can he be a top individual investor? Or is this just like people on tip ranks? I don't know. I don't have an answer. I can't believe there are people who are red who are in the top hedge fund managers. Average return. Now look at these guys. Some of these guys are doing pretty good. It doesn't tell you what hedge fund name. Wow, they're really picky about this. Corporate insiders. I don't even know what that means. Top corporate insiders. I guess it's if they know when their own firm is going to go up and down. I really don't know. But this is what I mean. The top performing research firms. This really drives me nuts. The best they've got is 70%, goes down below 60 right away. And by the time you get to the bottom of the top 10, 54%. A coin flip. These are the freaking research firms. A coin flip once you get past the 10th guy. He is neck and neck with a coin. There's no point. Whoever this guy is, there is no point to reading his report. You may as well flip a coin. This guy flip a coin. This guy is barely better than flipping a coin. Only this guy. Only this one guy is above 60%. And they've got 32 analysts at this firm. And it takes 32 guys. Well, this one's it takes 120 people to be as good as a coin. You guys really have to have more respect for what I do. I mean, come on, this is ridiculous. I can't believe it. I forgot where we were completely. I don't even remember what we were talking about. Something to do with Nike. Okay, right, Nike. There you go. So we talked about Nike, and I remember it was predicting. That's right. So predicting. So I told Bodie, you're not going to win the predicting game, and I don't play the predicting game because I just, we just put the trades up. We put up the top trades. We put up our regular trades in the portfolio. We have an average of 70-something% in almost any kind of market conditions. We generally are 70% right. And when you're 70% right and you manage your cash correctly, you make shit tons of money. And we do it year after year after year after year. The time I used to care about tip ranks was more than 10 years ago. It's ridiculous. They're technically not my peers. We don't have peers, and they are definitely not our peers. So anyway, so where were we? Yes. So Bodie is taking a look at Nike, and he predicts they're going to have a small beat. That's his primary consensus. So he says they're going to beat by 2 to 5 cents on a lowered bar, which they did have a low bar. It's going to pop 3 to 5%, and then it's going to give it back. Okay. What actually happened I don't know if you guys can hear that, but they're right outside my window now. So what actually happened is, that's why I keep getting confused, because I keep hearing like this drilling and stuff. So what actually happened is they beat by a lot, and the revenues were not that big of a beat, frankly. But what really did it was a restocking of inventory. And where did that restocking come from? And I didn't remember it to tell Bodie yesterday. I would have told him, obviously. I'm not looking for him to fail. But if you guys remember, we were playing Foot Locker, and then Foot Locker got bought by Dick's. And one of the reasons we were playing Foot Locker is because we knew they were, and we were also playing Nike long back at the time. It was about a year ago. And we played, so we got out of Foot Locker because we made too much money and it wasn't worth keeping the trade. And Nike, we just got tired of the bullshit with Nike, and we stopped trading them. But at the time, our premise was that Foot Locker and Nike were making up a year ago. That Foot Locker and Nike were making up. The new Nike president was making nice with Foot Locker, where they had discontinued the relationship 2 years ago, which actually started Nike's death spiral. It wasn't just Foot Locker. They pulled out of a lot of retailers, and they decided they were going to go concentrate on the Nike store and the online selling. That turned out to be a disaster, because realistically, their target audience wants to see a shoe on a shelf and pick it up and look at it and try it and buy it. They don't want to look at a page full of sneakers that they can't really get a feel for how it is and what it feels like and how it's going to move. That's not how you buy shoes. So getting out of the retail space for Nike was idiotic. That disaster, or that ship already sailed. So we liked Nike at the bottom, but they were taking a long time to go. Foot Locker really took off for us like crazy. So and they got bought, so that was that also. So Foot Locker, what the frick? Why is this happening? This didn't used to happen. Oh, because Foot Locker's gone. All right. Anyway, so Foot Locker just totally took off and got bought by Dick's, and there was no point in keeping them. Nike, on the other hand, kind of sauntered along. But the bottom line is they made their deal with Foot Locker, which we thought was a great idea, and that was somewhere around here. And the stock popped, which is what we always expected would happen. But we stopped playing them somewhere around here. We got out because we were just happy to get out. They made some money, and we were like, okay, that's it. Because they were too weird with the tariffs and all that. We didn't know what was going to happen. Anyway, so I mean, Bodie said 2 to 3%, and they're up 4%, so it's up higher than expected, but not so much higher. But the bottom line is that I could see this wholesale recovery, 7% wholesale growth, much stronger than expected. So what happened? And here's why I announced the sale. So Bodie's got a nice thing where he talks about Elliot Hill's new CEO for Nike. He's got a new strategy. People like him, blah, blah, blah. He's not brand new. He's like the old CEO came back. So then I said to Bodie, well, anyway, I've been talking to Bodie about what the Kobayashi Maru is from Star Trek, which is a no-win scenario. And and I said, you can't win when you make predictions, because you're adding something that's not necessary. You're possibly sending people in the wrong direction. And any given quarter is a roulette spin. You can't sit there and pretend you're going to predict earnings. Once in a while, something really obvious is going to happen, and I'll take a stab at it, and I'll say, oh, we can make a lot of money if this happens. But you're still playing percentages. You can never be sure. And he said, I nailed the key factor he completely missed. The Nike Foot Locker reconciliation was the big restocking. The restocking came from that. Nike products dropped from 75% to 60% of Foot Locker's purchases in 2022. And Nike made a deal in August that they would retake the position in Foot Locker stores for the first time in 2 years. And what does that mean? And this is shame on me for not realizing it at that time. But like I said, we were just happy to get out of Nike without a loss. But shame on me, because when that deal did come about, didn't think about the fact that it would have this immediate effect. Because how do you, when you have an agreement that you make with Foot Locker, How is that executed? It's executed by Foot Locker buying a bunch of Nike shoes and putting it on the shelves. Doesn't matter whether they sell or not in this particular quarter. They're on the shelves. Foot Locker bought the shoes from Nike. If they don't sell, we'll find out what a disaster the whole thing was in Q4, but at the moment, everything looks rosy. That's what that's all about. And then you also have to be aware that Nike's earnings are early, blah, blah, blah. So there's a lot to it. But anyway, that's how that happened. And this is how Bodie learns to take more things into account. Because now, next time we talk about something like that in retail, he'll go, oh, I remember that time that Nike had inventory issues and blah, blah, blah. And it'll become another thing he looks for. It's just like you and I gaining experience though. But if I don't point it out to him, if I don't teach him, he's not going to learn. Just like anybody else, really. But that's how he becomes more and more useful. He learns more and more stuff, and as time goes on, he gains experience, and he becomes better at it. And he learns things like don't be an asshole and try to predict stocks every time there's an earnings. It doesn't make any sense. You can't be that sure. That one actually we could have been that sure about if we had applied all the knowledge that was available to us. There's no excuse. I mean, we should have caught that trade. That was so obvious what was happening. And it wasn't like he was completely wrong. He said it would go up. He didn't think it would go up that much. And today we should look at Pfizer. So, let's ask Bodie. Now, how about Pfizer? There's a lot of moving parts with the Trump deal. Do you have to project earnings impact for 2026 and 2027? I would assume that, like Intel, Trump has a motive for PFE to do well now, so he can more easily make the next dozen deals. They'll make sure you have real numbers and a real understanding of the deal with all right, so Pfizer technically is a buy, and we were staying away from Pfizer because we knew that this bullshit was coming around with the pharma, but they got super cheap. Look, they're like they went from 14x to like 8 to 9x forward earnings. And this is a pop, but not in the grand scheme of things. In the grand scheme of things, they're still way down. We usually play Pfizer. Anything under 30, we buy Pfizer like crazy, usually. But this whole threat to the pharma industry and all the Kennedy stuff and everything else was like, who the hell knows what's going to happen next in this industry? It's crazy. But still, it's a worldwide massive business. And only they have to ask Bodie that too. How much is in the US? So they just signed the deal with Trump, supportive near-term impact, drug price reductions. Pfizer agreed to lower prices by up to 85% of select drugs via the new Trump RX government platform, and to offer most favored nation prices to Medicaid, pegging prices the lowest in developed economies. Tariff waiver. In return, Pfizer gets a 3-year exemption from new tariffs. That's a big thing. On branded patented drugs, shielding a critical part of its global revenue and supply chain. Pfizer is committed to invest another $70 billion. That's an unrealistic number. I got a problem with that. In R&D, innovation over the coming years. Why is that unrealistic? Because Pfizer only makes, well, oh, that's not them. So only is a weird word, but Pfizer only makes $18 billion a year. This was because of COVID. This is normal, 18 billion. So Pfizer only makes $18 billion a year. Oops. So where are they going to get $70 billion to invest in R&D? This is over the coming years. It's one of those vague bullshit things. Like, you remember how all these people used to promise Trump they'd build a factory, this and do that, and nothing ever happened. So it's probably more like that. Focus on cancer, obesity, vaccines, immunology. Again, these things don't make sense because we're only 4% of the global population. There's only so many drugs we can take. These guys have to worry about their outside markets. Pfizer could benefit from increased volume via TrumpRx.gov, even with margin pressures. Market responded positively. Analysts, industry interpreted the deal as a template for rivals. 2025 revenue, revenue 63, profits, well, EPS per share is $3, so it's 10x on 30. That's the key to it. Revenue growth remains fact, bottom line, tariff relief without the deal. Analysts estimated profits risk from 100% assets with 8 to 10 billion of exposure. Volume share offset, direct sales will add another couple of billion. Okay, he's taking that into account. Medicaid discounts, a couple of percentage more. R&D, the R&D ramp should offset margin headwinds with additional supply and savings. Okay, so the revenue stays steady, which is weird. The earnings per share stay steady. The EPS and so the EPS without a deal would have been there, and the EPS with a deal. So he says it's actually a net positive. That's interesting. Like Intel, a strong policy move to make Pfizer look successful, positive headlines, drug prices, so on and so forth. The U.S. expected to make favored companies striking deals. That's an interesting concept. Remaining outside PAC would expose rivals to tariffs and ceding competitive ground to Pfizer. The Trump deal protects Pfizer U.S. cash flow. What's PFEs in and outside U.S. revs and profits will other countries retaliate? So let's see what that one comes out like. Pfizer's breakdown for 2025 is projected at 53% and 47% international, so half US, translating to operations carry substantial. US operations carry higher net margins, right? Because we overpay for everything, while X margins are 11 to 14% higher. So in other words, the net profit in the US that's less than the total. So I'd have to see, I would go back and question about that and check the numbers. China eating Japan's top ex profit, while other countries. It raises concerns and frustration among European and Asian governments who fear most Asian prices will force new parity. Probably because they're probably going to raise the floor on everybody for what a price is, and that's how they're going to make up most of their profits. Farm lobbyists expect near-term pricing pressure from non-U.S. markets, but no formal tariff retaliation this year. However, EU officials have signaled upcoming farmer pricing reforms and stepped up regulations. So, it's possible this could sort of spiral into a thing where no drug companies can make money anymore because everybody does the same thing to them. By the way, also, all these things have sources. There's always sources, and that's part of it. I'm not, for the purpose of the webinar, when I do these things, first of all, this is not Bodhi. This is not the Bodhi that I use on my main computer. This is another version of Bodhi that doesn't have the same amount of experience. There's nothing wrong with him, but it's not. The nuances aren't there for this Bodhi. So it's a little different, but this is a very important thing, though. I'm not taking the time that I usually would to read these things myself and to double check all his figures and to whatever. But that I did catch is I said, well, no, this isn't right, because I know Pfizer makes $17 billion and you're coming up with a number that is $10 billion. So clearly you're missing something. And then so we'd have to dig to the bottom of that, and I'd have to check where you got these figures, which I guess, nope, I don't see it. So we had to find out where you got the figures. We'd have to go back to the sources. I'd have to find out the thing. I'd have to check with the other sources to find out what's correct. Yeah, if you don't do that, what's the point? If any piece of data, that is the thing people don't understand about data and AI, quote, hallucinations, is especially once you start involving calculations, and everything is a calculation, but it's like if you get the revenue wrong, then the margin is wrong. Even if the profits are right, then your margins are wrong, and then you're making false assumptions about all sorts of things in the business. If you think, if you think you're running a business at a 40% margin, you're really running it at a 12% margin because you didn't take something into account properly. The fact that you got the profit number right doesn't mean that you got anything else right, because your entire analysis is based on the fact that you thought they had 40% margins. Not to mention the amount of sales and the market share and so on and so forth, and the taxes they have to pay. It's a lot of stuff. And that's how these hallucinations, which is a mistake, but that's how hallucinations snowball into completely ridiculous wrong numbers coming out of AIs. And the problem with an AI, that's obviously not my problem, I look at a number and say, that doesn't look right to me. AIs don't do that. They get a number, and the number that they get, don't forget they're looking at hundreds of numbers in spreadsheets. You do it too, but you focus. There's a big problem. See, when I look at this, look at all these numbers, right? I don't give a shit. I care about this. I care about these two numbers: revenue, profit. Okay. Once I have the revenue and profit in my head, then I might look down and say, oh, how much debt do they have? What's their cash flow look like? What are their dividends that they're paying out? Oh, they pay out 170 in dividends. That doesn't mean anything unless you know how many freaking shares there are. It's 170 times what? And I already know, that these guys don't have very good share counts. Now I could go to, now share count is on this one, and somewhere around here is a share count. Shares. Okay, so I could go 5 point. Now I know it's 560 times 1.7, and that means 5.6 times 1.7. Neither one of them has the proper number unless you do it yourself. They're paying 10 billion freaking dividends. I mean, it's not awful because they're also making $17 billion, so that's okay. But they pay a lot of money in dividends. But that's also cash flow, and it's also a safety net, because if shit hits the fan and the economy crashes, all they have to do is tell the dividend holders not this year, and obviously that would lead to a sell-off, but you don't really care if you need the cash flow, because the cash flow is more important. Better to increase your cash flow than to go out of business because you kept paying dividends to shareholders who said, I don't care how much the economy sucks, I want my check. It's one of the stupidest things that companies do, is just keep paying the dividends even when they're tight on money. Like they look, like some companies borrow money. Some companies borrow money to maintain their dividends, to keep paying the dividends. And, you know, you can say there's some logic there. You can say, well, they, you know, the people bought the stock expecting a steady dividend and their retirements count on it and blah, blah, blah. And just because we're having an off year doesn't mean we shouldn't keep, you know, our promise to our shareholders that we pay a steady 5% dividend all the time. But that's horseshit. Any rational shareholder, and they're at 6.25%, any rational shareholder would want them to make more money and continue to grow. No, and ultimately you get rewarded anyway, because let's say they kept growing, all of a sudden they stopped. Let's say they didn't pay the dividend, they took that $10 billion a year and put it into growth. And they grow, instead of growing at 5% a year, they start growing at 10% a year. Well, then in 6 years, they would be twice as big. And then they could do a stock split 2-for-1, and then you'd still be getting your dividends, except you'd be getting it on twice as much stock. And that would be all time going forward. What would you rather have? You know, in the long run, I'd rather have that. But in the short run, you're going to scream and yell and curse because they're not paying you a dividend. It's crazy. The dividend treadmill is not a good game on the whole. And I really noticed that when we were playing our dividend portfolio a couple of years ago, I noticed that about the dividend stocks, is they're very frustrating because they're taking so much of their cash flow and putting it into dividends, and opportunities are just flying past them. And you think it's okay, but it's not, because over time your company is becoming uncompetitive. Because instead of taking the money, like a tech company, companies don't pay dividends, they're investing in tech. And that's why they took over the market, because they took all their money and put it back into the company. And not only they put it back into the company, but they go out and get more money. They go and raise more capital because they constantly want to be investing, because they are always looking to the future. Whereas these other companies are looking to maintain their market share, to make a 1-2% gain in revenues next year, to come up with like one new drug out of, you know, like Pfizer's got, what's the number? 60 billion, I want to say. Yeah, so Pfizer's got 60. I don't know why I look. It's like I know the numbers. I just don't want to say it until I check. So Pfizer's got $60 billion in sales, and they will spend billions of dollars. They'll spend $12 billion developing a drug that's going to make $2 billion a year, which is considered a very good drug, and maybe makes the $750 million a year in profit. And after 20 years, they're going to make 50% on the money, which is fantastic, which is great. Incremental growth, a couple of percent every year is added by one drug. And so they come up with another drug next year, and another drug next year, and another drug next year. But the thing is, if they weren't paying $10 billion in revenues as dividends, they could be developing 2 drugs, 3 drugs, 4 drugs a year that are blockbuster drugs. You don't know where it's going to end. They're not even trying. I mean, of course, yeah, we have R&D on 5 projects right now that are major, and we're hoping to develop this, we hope to develop that, but some of them work and some of them don't in drug trials. On the whole, I would rather they have money, as long as they don't waste it, but they don't waste it. They know what they're doing developing drugs. And that goes for you know, almost any company paying out these crazy dividends, even these oil companies. Like, go find some more oil. Come up with better drilling techniques, invest in technology, become a better driller, create carbon capture things, do some stuff, find a new thing to make money. Why do I have to go out with my limited resources and figure out what the next big technological thing is in other companies, when you, Occidental Petroleum, for example, are paying, and I'll tell you right now, not here. So Occidental Petroleum with their shares. With their billion shares. So Oxy's got 1 billion shares, and they are paying out $1 billion in revenues. Okay, so they pay out $1 billion in revenue on 1 billion shares, and we already said they make $2 billion. So half of the money they make is being paid out in dividends. Instead of, they could have bought Permian 10 years ago, and in 10 years they would have made $10 billion more dollars. They could have bought Permian with a loan or cash flow or whatever. They could have taken their $1 billion a year they paid in dividends and instead acquired this entirely other company that's growing and expanding, and now they got to pay $10 billion for it. They probably could have bought it for $2 billion 10 years ago. But instead, you had to give the freaking money to the shareholders. And what did the shareholders do for it? They invested in 10 companies that busted or 9 out of 10 companies that busted on them or didn't do that well. Occidental had the positioning and the people and the location and the infrastructure and the operations to make great use of that money, but they didn't, because instead they paid a dividend. All right, so think about that when you're buying dividend stocks. Okay, why are you running a company to hand money to the shareholders? You're the, if you're going to buy a company, I want to buy a company where I believe the management of the company is capable of expanding the business, not maintaining it so they can pay me a dividend. That's, a bank can do that for you. Banks are paying 4% and more now on deposits. So give the money to the frickin' bank. So what are you doing? Why you want 2% from this guy? He's a dividend payer. It makes no sense. And again, I'm not saying not to play the stock. I'm just saying conceptually, don't play it for the dividend. So that's what I'm saying. It's not necessarily the best ones. And again, that was my problem with the dividend portfolio, and that's why I didn't renew it this year. Because I'm like, it's not a good place to put money. Concentrating on dividend stocks is not, it's really not. We can pay ourselves much bigger dividends, because look, Oxy pays 2%, right? So I buy Oxy for $47.50, and OXY. So I buy Oxy for $47.50, and I sell the January 47.50 calls for $3. That's all premium. So I sell the 47.50 calls for $3. 3 divided by 47.5 is 6.3%. So in 107 days, I'm going to make 3 times more money than the dividend for the year selling those calls. And what's my downside? My downside is if the stock drops, I'm only paying net, because I sold the call for 3, I'm only paying $44.50. So I'm actually protected against a 7% drop in the stock. That's built in when I buy it. So it's already, so if the stock goes down, I'm better off. If the stock is flat, obviously I'm better off, right? So if the stock is down, I'm 6% better off than if I didn't sell the call. If the stock is flat, I'm 6% better off than if I didn't sell the call. And if the stock goes up, what's going to happen? If the stock goes up more than $3, I'm going to only make $3, but I'm still going to make $3. So the only disadvantage is if the stock goes up more than I thought it would, and then I would miss out on those gains. So I'm capping my upside at 6%. But if the stock is flat, so in other words, the stock is up, I make what I plan to make. If the stock is flat, I make 6% more than I thought I was going to make. And if the stock goes down, I save myself 6% on any damage caused by the stock. So in no way, shape, or form am I worse off. So then we carry that logic to why buy the stock at all? Why should I tie up $45 of my own money? Because I'm making my money off of the short sale. I don't give a shit about the 2% anymore, because I'm making 6% 4 times a year. So I have 4 times, and I'm going to collect 6%. That's 24% versus 2%. And therefore I don't need to own the stock. What can I do instead? I can buy the $45 calls for $10 instead of $40. And these are 2028, so I got 2 years and 1 quarter to sell. So I got 9 quarters to sell. And if I want, in lieu of ownership, I can sell these short puts, and these are 450, 460. So if I sell these for 40s for 460, I'm netting in for 33.40. 33.40 is $14 below. It's about 30% below the current price. So my worst case is I own the stock for 30% below the current price. My best case is I'm taking this 1085 and I'm collecting, what did we say we're collecting, $3 or something? And I'm collecting, wrong year, collecting 330. So it's 330, well, it's 330 divided by 1085 is 30%. So now I'm making 30%. I'm not even counting the put money. I should count the put money because it's 1085 minus 340 or 330 minus, what did we say those puts were? Minus 450. So that's my initial position. I'm spending net $3. And I say, again, what's the worst case? The worst case is we get assigned at 40. I don't mind that. And if you want to call it 43, it's 43. But either way, it doesn't matter. It's well below where we are now. As my worst case, that's if it drops tomorrow spectacularly and we get assigned at 43, at 40, then we lose our $3 and we're assigned over here. That's the worst case. If it doesn't tremendously drop, then this is just our net. Once we get past January, this is our net on the spread. And then once we sell the next month for $3, then our net cost is 0. And then the worst case is owning it at 40. And then every time we collect another $3, it's 30. It's net 37, 34, 30, 31. It keeps, its net keeps dropping on our worst case. But what really is happening is the cash is piling in. We've got our short put obligation, and money just keeps pouring in and pouring in and pouring in at a rate that is 15 times more than you make selling the dividend, collecting the dividend. And we're tying up we're tying up 10% of the cash to do it. There's no comparison, and that's what it is about the dividend portfolio. It was pointless. There was no, we played it for 2 years, and I just decided, I'm like, it just made no sense. In fact, we just got rid of the dividend collections in the long-term portfolio too, because there's no reason to do it. There's no net dividends. The only thing it's good for is like a butterfly play, because like AT&T has been 30 for 20 years. Why? Because they give away all their profits. They can't make traction. So if you want to play a butterfly play on a stock that's going nowhere, that's a good way to play it. Because our biggest danger in a butterfly play is not really the downside. I mean, sure, of course, if somebody goes bankrupt, we lose our money. That's one danger. If it goes way so far down that we have no basis anymore, then we lose money in their butterfly plays. But if the stock gets called away at a high price, that's when we can get burned also. So we worry about a stock going bankrupt, and we worry about a stock getting bought out. Why? Because we have no further play. That's the end of the game for us. As long as we can keep rolling and keep selling, we almost never lose on our butterfly plays. That's why the butterfly portfolio works so well. And again, though, I didn't renew the butterfly portfolio because, half of our plays in the long-term forward portfolio follow the same strategy. Anyway, all right. So I'm going to call it a day. Get your questions in if you have them. So Pfizer, we talk about Pfizer a little bit. Let's get to the actual trade. So we like Pfizer. It's kind of getting away, but not really, because as long as it's under 30, it's still a great bargain. Brendan's asking, would you cover Pfizer if it's currently uncovered? I would only gently cover it, like a tiny bit, because it's still way undervalued. I mean, it's you know, if you stop worrying about what Trump might do to them, they're trading at 10 times earnings. That is stupidly cheap for a phenomenal company. It may drop, you know, the earnings may drop off more than Bodie's expecting in this thing. You know, I just worry about retaliation from other countries and stuff, but you know, they're under Trump's wing now, and we are. I mean, you know what it is, because in Russia or China, you don't bet against companies that Putin's got his arm around the guy. With Jack Ma being a notable exception, right? They suddenly turned on Jack Ma and screwed that guy. Although he came back, you know. But you know, people go in and out of favor in these parties. But the thing is, when somebody's in favor, you don't bet against them. You bet against their enemies. You know, so Pfizer is in with Trump. They're paying him money. They're the first big company on his Trump RX plan, and he will be best friends with them until somebody makes him a better deal. Then he'll stab him in the back. So just got to keep our eye on that and make sure nobody's cozying up to him. Just like Elon. Trump was 100% team Elon until he wasn't, and then it changed. But you know what? Elon's making money anyway. Not that he should be. It's ridiculous. Tesla's ridiculous. But anyhow, so Pfizer. So it's the same thing. It's pretty bulletproof for us, because all we have to do is say, okay, I'll buy Pfizer for $25 minus $3.50 or $3.70, whatever. But so 25 minus $3.50 is $24.50, $22.50. So I will buy Pfizer for $22.50. That is 20% below the current price. So there's no skin off my back to selling these puts. That gives me money to put into here. So if I sell, again, if I sell 10 of those for 3,500 bucks, now I've got 3,500 bucks towards the spread. I think 30 is at least the right price for Pfizer. So if I look at selling the 30 puts for 270 or 275, and I pair that with, oh, no, I'd rather sell these. So sell these for like 480. So 480 minus 275, and it's a $5 spread. And it's basically $2 on a $5 spread, right? 480, 275, yeah. So $2 on a $5 spread. These things are $3.50. So if I sell half as many of those, so 3,500 of those and 20 of these at $2 is 4,000. That's net $500 on a what did I say, 20? So on a $10,000 spread. $500 on a $10,000 spread is one way to play it. Or I might say, well, that's such a phenomenal deal. I don't need that good of a deal. I can go 15-20, like only have I have 20 longs and 15 shorts. It'll cost me more money. How much will it cost me? It'll cost me 5 times 25, whatever that is. It's cost me a couple of $1,000s more. But then I say, well, is that worth it? I say, well, of course it's worth it, because now I can sell 7 of the 2750 calls for $1.40, right? And that's 7 times 140 is 980 times 9 quarters, 8,000 bucks. So I'm going to lay out 2,500 now, and I'm going to collect 8,500, 8,200 bucks later. That's called investing. It's not gambling, it's investing. If I spend $2,500 now, I open the window to collect $8,200. That is an investment. That's how you become an investor, by investing. You invest in sure things or nearly sure things or incredible statistical probabilities, which is exactly, it goes back to the whole beta housing, right? That's what a casino does. I buy a roulette wheel and I keep the profits from the game. you come to play roulette. You're the gambler, I'm the investor. Okay? You're coming to play roulette and I'm investing in roulette. Why am I investing in roulette? Am I absolutely sure you won't win? No way. You will win 1 out of 35 times, right? Or actually, that's the trick though. You won't win 1 out of 35 times because there's there's 36 numbers. So you won't win 1 out of 36 times because there's a 0 and sometimes a double 0 on the wheel. And so if there's one extra number on the wheel, it puts the wheel 3% in my favor. If there's 2 extra numbers on the wheel, it is because I'm only, I'm sorry, and you're only paying 35 anyway, so you already have it built in. So I'm sorry, let's keep this straight. There's 36 numbers on a roulette wheel. If you hit the number, you get paid 35 to 1. Okay, so you already have a 3% disadvantage. Essentially, every time you bet $100, you may as well just give me $3. That's what a 3% advantage does. Now, if I add a 0, I now have a 6% advantage. And if I add a double 0, I have a 9% advantage every time you spin the wheel. That's why you lose money so fast at roulette. Every time you spin the wheel, I have a 9% advantage. So effectively, if you have $100, I take 9 of your money every time you spin. Whether you win or lose, I'm taking $9. When you lose, I take it all. But if you win, I'm still taking $9. So as long as you play 10 times, I'm not getting my money. The other advantage I have is I have more money than you. So if you hit the jackpot, if it lands on your number, I pay you your 35 times winnings and you're happy, right? But you'll spin 35 more times and the odds will catch up to you. And whether it's you or the guy behind you or the guy next to you or the lady down in the corner, blah, 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 the more people that play, it's the more total spins there are, it evens out for me. Because that way the laws of statistics come into play. If you flip a penny 3 times, you can easily get 3 heads or 3 tails, right? But if you flip a penny 3,000 times, you're going to get 1,500 heads and 1,500 tails almost all the time with a very, very small margin of error. So my winnings are a mathematical fact. I will win 9% of all the money that is bet on the table, and my wins and losses will come out even at worst over the long haul. I will probably break even. Now, there's all kinds of factors. Somebody may come in with $1,000, win 35,000, and most people are playing $100, and I only win 100 here and 100 there, and it takes me a long time to make my money back that way. That's why the house has limits to prevent that from happening. And again, statistically, they know that as long as the minimum bet is X and the maximum bet is Y, and as long as this many people are going to play, and they have a 9% rake every time the wheel is turned, they take 9% of everybody's money, not just yours. They take 9% of everybody's money every single time the wheel is spun. And once in a while, and you know it doesn't happen that often in roulette, once in a while, well, it happens, it seems to happen often because people make multiple bets. But in reality, it's not. And you've seen that. You've won at roulette and you've won at roulette and played and had fun and done all this playing. And then after a few hours, like, I don't have any money. It's like, well, what happened to the time you won here and the time you won here? Well, you know, I boxed it in. I had the bet here. I had the bet here. And by the time they paid me, it was nothing. By the time they paid me, I barely broke even on the spin. It seemed like I won a lot of money because I got a big stack of chips, but they took a big stack of chips that I had thrown all over the table to get there. So that's what's happening here. We are the house. We're running the game. We're selling the premium. We are taking our cut every single quarter. Win, lose, or draw, we are taking our money, and it is a mathematical, statistical fact that over the long haul, we will make money. Will we have a good run and a bad run? Sure. What is our biggest problem? If the game stops, if the stock goes bankrupt or if the stock gets bought, those are bad things for us because the game stops. And that means wherever we are when the game stops, we're stuck there. And we have to start a new game. And we're not gonna win this one. Yeah, and that's the other thing, you gotta learn to walk away from those things. So like when Foot Locker got bought out, the game stopped for us. There's no more game. There's nothing more to sell. It's over. It got a price. It's done, and it's just going to get called away. So you don't want to overexpose yourself to things like that. One way to prevent that is don't short too much on stocks that have ridiculously low values. Pfizer is one of them. We wouldn't want to overextend the short calls on Pfizer because we worry that even at $135 billion, they could get bought out. They're not, because these days that's not that much money. Look at Occidental. Buffett sneaks in and buys them. Basically, he took 30% of the company already. Now he's buying their chemical division, which is what? It's another 25% of their profit. So he may as well bought another 25% of the company. In fact, it's smart because now, if he would have bought 10 billion more of Oxy stock, then he'd be the owner. He'd be the 51% owner of Occidental. He didn't buy it though. He bought the chemical division of Oxy for $10 billion and took it out of Oxy and put it into Berkshire, and he still is technically only the 30% owner of Oxy. There's lots and lots of moving parts, but the point is, you got to get this mentality and get off the dumb side of the table. Learn the business of selling premium. That's where the money is. Okay, 1 million people a day walk into Wynn Resorts. I think Steve Wynn's dead now, but whatever. But 1 million people a day walk into Wynn Resorts, and none of them are as rich as Steve Wynn. And we're talking about like really rich people. Not everyone, but I mean, billionaires go to Wynn Resorts and gamble. Mark Cuban goes to Wynn Resorts and puts money on the craps table. But Steve Wynn has billions of dollars. He's got, just the Mirage and things like that. Not the Mirage, the Encore, whatever those towers are called, those big new ones. Those things are like $10 billion. Those towers, and plus he owns the Mirage and he owns other stuff. He started with the Mirage, I think. Treasure Island they own. I mean, they own a lot of stuff. But the point is, and what's his face? Comdex. What was his name? We used to hang out. He's such a cool. Shelly Addison. He became a psycho-conservative. But back when he ran Comdex in the old days, me and him used to hang out. I used to love it but that's when Comdex was a thing. He rented it. He rented a part of a casino, the Sands Resort, and he rented it out, and it was a rinky-dink show. And I used to go because I was a tech geek and a nerd. Plus, it was my job. So I used to love going to Comdex, and I became friendly with Shelly. And he was a hustler more than anything else. But what did he do? He took the money, he poured it into stuff. He got enough people together. He bought the Sands Casino, which he had the biggest convention there anyway. He got into the convention game. He built more convention space. He made it a premier site. He made more money and more money. Why? It's this attitude. It's the attitude of being the house. Even Comdex itself was, he would rent the whole place and he would then sub-rent it out to other people. That's what we do with options. We rent a space and then we rent our space to other people who pay a higher premium than we do for the same space. We're landlords. And he took that and wrote it, and he was great at getting investors together. He was great at getting people to do things. It was fantastic. And he turned that into billions and billions of dollars, which he unfortunately gave to conservatives. But either way, but you just have to learn that that's how the money is made. The money is not made by betting Tesla's going to go up or down. Anytime your net premium is more than your positions, you're doing it wrong. So let's keep that in mind. That's going to be the lessons for future weeks. We'll get more into it. And we'll see how the quarter takes off. At the moment, I'm just dumbfounded, really. I got to admit, I don't understand why. Oh, Let's go to the tape. Hang on. You got a little bit of time. I can do it. So we wrote a lot of good articles this week. Yeah, actually, the last 2 weeks. A lot of overall interest articles about the markets and valuations and so on and so forth. Today we wrote about the shutdown and something else I forgot. Oh, Trump's freaking general meeting, or Hex's general meeting, whatever. Doesn't matter. You know, it doesn't matter. But if I don't write a post about it, or Hunter wrote the post, but if I don't, if I don't put a post up about it, I feel like I'm just like hiding from reality. And when, when the world is, when they recover the ashes of this world, I want to make sure that we did take a stand. We didn't just sit there and watch it happen. Anyhow, I think it was the last thing I asked Bodie to do. Yeah. So he said, yeah. He goes, this is a perfect example of what you've been teaching about disconnected markets during institutional breakdown. I'm sorry, I want to just double check to see where we are at the moment. Oh no, it's trade, active trader. Yeah, look at this, up, up, up. I mean, just amazing. Whoop, just close the wrong window. So the future is blah, blah, blah. We were down quite a bit in the morning, and all of a sudden everything just turns around again. But I think I said before, it's the money flow. It's like, what else are you going to put your money into? What are you going to invest in? So they're looking at previous shutdowns were not a big thing. They didn't impair the market or do anything. But both the previous shutdowns were mostly short term, and they weren't coming at the top of a market. That's another thing, though. If this goes on for more into next week, it's going to start having some serious impacts on us. It's 0.2% of our entire GDP per week. Not to mention I mean, how could I asked last week, how could consumer confidence be any lower? Well, you know what? You could shut down the government. You could you could furlough 1 million workers, and then make them feel insecure that their job is going to come back, and all of a sudden, yeah, you can knock consumer confidence down another 5%. He goes, this is the scariest part. Markets are pricing in Trump's military consolidation as a good thing. Military control of the cities is a law and order for business. The government shutdown is less regulation, less oversight, and authoritarians have predictability versus uncertainty via democratic institutions. It's insane. Gold hit all-time highs while Bitcoin surged. This is your entrepreneurial fascism thesis. Smart money is fleeing to safe havens while retail money gets trapped in equity. Also, by the way, the dollar is diving. So that's also devaluing. The dollar's devaluing, therefore equities and commodities are going up. Defense contractors are up because we have a Department of War now. We changed the name of the Department of Defense. These are no longer defense contractors. They're war contractors. We don't have a Department of Defense anymore. We have a Department of War. Trump just met with his Department of War, and 800 generals from the Department of War gathered to hear what the president and Hegseth had to say. And the Secretary of Offense, I imagine he must be called now, because we no longer have defense, we have offense. So the offense contractors or the war contractors are up. Government dependent stocks are down because there's no government. The market is pricing in permanent military state rather than a temporary shutdown. I'm sorry. I think it's like the worst. It's really like technically gallows humor. It's like it's not really funny. It's but what are you going to do? That's what's happening. This is what America is now. Volume analysis, low volume rallies, algorithmic buying, index rebalancing. There's no real investor confidence here. America's watching democracy die while CNBC discusses whether the Dow will hold 42,000. It's all true. It's so horrifying. This is an AI's outside point of view on things. The market reaction irrational. It's rationally pricing in authoritarianism. Stocks go up when property rights are protected by force, even if human rights are crushed. When property rights are protected by force, stocks go up. German stocks rallied in 1933 as Hitler consolidated power because business leaders thought authoritarian stability was better than democratic chaos. Markets up because Wall Street is betting on successful fascism rather than a failed democracy. That should terrify everyone, but instead it's being celebrated as resilience. The VIX at 18 shows dangerous complacency, while gold records show institutional fear. Retail investors are buying the rally, while smart money is hedging for collapse. And good luck selling bonds when we're 37.5 trillion now. We're $37.5 trillion in debt. We are trying to sell another $500 billion in bonds before January 31st. I'm sorry, before December 31st. We will be $38 trillion in debt at the end of this year. We will be over $40 trillion in debt next year. And we're asking for Europeans and Japanese and Chinese to borrow more and more and more and more money. It's going to pop one day. Maybe not today, maybe not tomorrow, maybe not next year. It will pop in the most horrifying, worst possible way, and there are not going to be any buyers. So if you don't keep one hand on the exit door for this party, you're making a big mistake. Okay, the cops are on the way. We're having a kegger. Everybody's wasted. It's 3 a.m. The neighbors have called the cops 10 times, and they're on the way. And they will stop this party. You just don't know when they're going to get here exactly. Okay, but the people who don't want to get busted, they're the ones that are standing around the doors and they're trying to be cool and hang out at the party, but they're watching for the lights. They look outside, and when the door opens, they're going to slip right out. When the front door opens, they're going to go the other way and get the frick out of the place. And you gotta be ready. You've got to have an exit plan at all times in this market because this is insane. And look, and I said last week, I said this is more like 1998 than 1999. 1998, the markets had doubled over the last few years, but in 1999 they doubled again. Between 1998 and the end of, and into 2000, they doubled again. The party went into a whole nother gear in 1999. And even though there were companies that were crashing, even though there were plenty of warning signs of these .com companies that overextended and spent too much and did this and that, it didn't matter. There were too many other companies that went up 10 times from their IPO and things like that, and money just kept flowing in and flowing in and flowing in until the whole thing just completely collapsed under its own weight. And there is no way anybody can tell you exactly when that's going to happen, but I can tell you it's going to happen. Because this is not sustainable, and it's not sustainable. Again, I said I wrote a bunch of articles in the last week, and one of them was, this is not sustainable because there isn't enough money in the world to feed the beast. As the market grows, as the market cap grows of the U.S. equities, which is now getting close to $70 trillion, the 60-something trillion dollar figure we were using a couple of days ago was from the end of last year. And now we're up 12% more. So add another $6 trillion. We're getting very close to $70 trillion in market cap in U.S. equities. And that's more than half of the entire rest of the world, because I'm sorry, it's more than half of the total world. It's more than the entire rest of the world combined is U.S. equities, and U.S. equities are 1/3 7 companies. Those 7 companies are worth more than all the rest of the stocks in the world. That's really messed up. NVIDIA by itself, $4.5 trillion. Only China has a bigger GDP than $4.5 trillion. Every other country in the world is smaller than NVIDIA. Why does NVIDIA not have a seat at the UN? You know why? Because that would be ridiculous. And you know why that would be ridiculous? Because it's not worth $4.5 trillion. It's a bubble. It's going to burst. And don't be the guy in the middle of the room, you know, doing a keg stand when it happens. That's all I can say about that. All right, so let's enjoy it while it lasts, and I'll see you guys next week. All right, take care, everybody. Oh, Marco says, can you please share the Pfizer example as a masterclass in the comments if you remind me in the comments? Well, I don't know what I said. I don't know what I said, but I could sure try. All right, take care, guys.